Hello, welcome back to the continuing lecture in financial statements. Now, in our last video, we stopped right before defining the assets, because assets are used very. It's a term that is used very broadly, but to make clear distinction, right? We will need to we need to make a clear definition of assets. Assets can be defined at least on three levels, just like liquidity being defined on three levels. First, in accounting class, if you've ever taken accounting, assets are defined as what you own, right? Assets are defined as what you own. And then liabilities are defined as what you owe. Now, but I always find this definition a little lacking because it's incomplete. Why? It's missing the definition of equity. Obviously, it makes sense. Assets are what you own, and some of the assets came from liabilities, right? Which is what you owe. But what about equity? Is equity what you owe? No, equity is not what you owe, but it is what you own, right? Now, of course, there's another explanation for that. I mean, the question is, if equity is not what you owe, but why is it put on the same side as liability? Well, it's not. So the conclusion is, it's not actually what you own versus what you owe, right? It's actually, it's actually the distinction between where the capital came from and how it is held, right? So think about it. The company's total assets is 10 billion, right? Roughly 10 billion, right? And 60% of it came from debt and 40% came from equity. So that's the definition of capital structure. So basically, this $10 billion, right? Capital of $10 billion that was raised through debt and equity, right? Are held in the form of physical assets, right? Plant and equipment, land and building, and also in the form of current assets, right? Now, so the definition of what you own versus what you owe is not complete. And besides, if you explain what you own versus what you owe, equity is what you own, but it is still on the liability side. It's because that's where the capital came from to be put into these assets. Another explanation for equity, for being on the liability side, is that equity is what the company owes to the owners. Okay, well, if you look at it that way, right? If you separate the company from the ownership as a third party entity, as if it is a third party entity, then that explanation fits well. But again, yes, and it's quite it's quite a good explanation, because I've been telling you, ownership, right? Owners are not necessarily the company. Owners own the company, but the company is like a vessel, right? Company is like a vessel. So owners, and the company is a vessel and a mechanism, but company is an inanimate object, an inanimate entity anyway. So company doesn't retain. I mean, a company doesn't get the final ownership or claim on the profit, because profit is claimed by the eventually by the owners. But the company, since comes a vessel and a mechanism to maximize its machine, right? Company is a vessel and a machine to maximize the profit for shareholders. In that sense, right? In that sense, you can, separate the owners. You will need to separate owners from the company, and also, it's also the characteristics of the modern corporation, right? That the ownership and management are separate. You understand? Owners are not necessarily the management. Owners don't have to be the management. Owners own the company through stocks, through equity. The company is run by the management. Management is actually hired by the ownership. And if the management is doing a good job, the owners will keep the management, paying very high salary, outrageous salary, and keep the managers. But if the managers fail to live up to the goal, owners, set target, then they can be fired, and new search for new management will begin. I mean, of course, they will hire, search for the new management first, and then fire the old management later, after the search process is over. So the in that sense, yes, equity is what the company owes to the owner, to the owners, and but I would, if you define assets and liabilities, I mean, if you define it in terms of own and owe, right? I would say equity is what you, and when I say you, it's the owner, right? Owners own free of it, right? Now that's the first level of definition of assets, what you own and versus what you owe. On the second level, as we look at the balance sheet, it's already the definition of assets. Total assets equal total assets are equal to total liabilities plus equity. In other words, this is called accounting equation. Assets or liabilities plus equity. I will just, because writing, liability takes time, I'll just call that a total debt plus equity, right? Debt plus equity. This is called accounting equation. So that means that's also why it is called balance sheet, meaning both sides must balance out. There must be the equal sign must hold, right? So that's basically the structure of balance sheet. On the third level, this is pretty much I would say very important concept of assets. Assets must generate income. Assets must have power to generate income, right? Assets must have income generating capabilities. Okay, understand? If assets have no income generating capability, they have no reason for being. They have no reason to be, and their value, although this is called book value. Basically, book value is the value recorded in the financial statement, in the balance sheet. Now, think about it. Book value starts with the purchase cost. Plant and equipment, this $6 billion is the purchase cost of plant and equipment if we are at time zero, at the beginning. And each year, right, this book value will go down because, why? Because of depreciation. In other words, what's depreciation? It's the literally, it's the decrease in the value of the asset. But then the value of the asset naturally decreases because as you use those assets, due to wear and tear, right? It's aging simply, right? As you use the assets, it wears and tears, so the value goes down. It's not just the because it's not just you might say obviously, when you will say the value will with aging everything, the value of everything goes down. Yeah, true, but think about a building, right? Value. If you are not doing any maintenance, right? The building will clearly go down in value because of dilapidation, right? But think about the production equipment. Think about the plant. It's not only because of aging. With the aging, with wear and tear, what goes down too? The production capacity goes down too, isn't it right? As the production equipment, right, plant and equipment ages, the wear and tear brings down the productivity and the production capacity, right? Yeah. A very simple example. I don't need to even bring up a simple example, but everything when it is new are at its maximum production capacity, highest production capacity. Suppose you bought an air conditioner, right? But at the beginning, at time zero, right, in the first year, what do you notice? You notice nothing. The only thing you notice is, the temperature, room temperature has drastically gone down, right? In a matter of seconds. But you don't notice, you don't hear anything. No noise, very quiet, cools the room very quickly. But as as time goes on, what happens? Second year, third year, fourth year, it takes more time to cool the room to the same temperature, right? It takes more time. And that means it's not getting that cool very soon. It's still very warm. And besides, you hear a lot of noise, right? At time zero, it was very quiet. Now it's a clunker. It makes a lot of clunking noise, right? A lot of noise. So what does that mean? The productivity has gone down. Why? Due to wear and tear. Make sense? That's depreciation. At time zero, plant and equipment may have been 6 million. Building may have been something. Land doesn't depreciate, right? Land doesn't depreciate. But by the way, but here, depreciation is defined this way, but actually depreciation has more tax implication. I mean, there's a huge thing that the depreciation does in terms of, tax savings, reducing taxes. Okay, so we'll talk about that later. But when assets are defined as something that has income generating power, that income generating power will gradually go down if you don't do anything about it. Of course, nobody will just, no management will just, watch it just hands down, right? Because if due to depreciation, if the production capacity goes down, that means their output goes down. As output goes down, the revenue will go down, right? So, and as the revenue goes down, and output and revenue goes down, the market share of this company goes down, and no management will just, watch it hands down. So, what do? They replace the worn out portion of the capital, or even expand, right? To maintain, a constant production capacity, or even expand the production capacity, right? Now, assets, so that's the book value of the asset, and the market value of the assets. A market value is a different thing, right? Market value would, by definition, it is determined by demand and supply. So the market value may be will be a different thing from the book value. Now, our question is now, I need to, so when we, there will be a further discussion about the, the specific line items of current assets and specific line items of the current liabilities later in another video. But I want to wrap up, because the whole point is, how does this have to do? How does it tie in together with return on investment? At the beginning of the this lecture series, I said ROI on micro, in micro context. In other words, from firm's perspective, are defined as return on assets and return on equity. So think about it. If you are an investor, right, you would want to know, suppose you are buying, considering to buy stocks in this company, and you would want to know how much is, how much is the, on average, how much return you get on equity in general. So the formula for return on equity is, what is return? I've been telling you, a profit is the return, right? And if you divide profit by equity, right? Of course, that's return on equity, right? And of course, the higher the number, the better it is. Because equity is the input, profit is the output. For example, this company's equity is 40 billion, right? 4 billion, right? And suppose this company's, profit was 1 billion. I don't know if that was the number was there, but if this is the case, what is the return on equity? It's 25%, right? 1/4, 25%. This is pretty good, right? Compared to average return on equity. Now, in other words, it is output to input ratio, and I've been telling you, the output to input ratio is a very solid and fundamental measure of efficiency, right? Productivity is a kind of efficiency, right? I mean, obviously, for minimum input, if you get the maximum output, that would be wonderful. For some to put maximum output and get maximum input and get minimum output, and obviously that is you don't want that. You want to avoid such an investment opportunity. Now, what is return on assets? It's also a profit over, now this time, total assets. Why? Total assets is also input. Think about it. Plant and equipment. I mean, that $10 billion capital is asset, total asset. And what is asset? Assets are the machines to generate income, right? Assets exist. The sole purpose of asset, right, is to generate income. And so it's like, none of it has to be lean and mean. If you weigh 200 pounds and if you're all bone and muscles, then there's a lot of you can lift a lot of weight. I mean, compared to the same 200 pounds but full of just fat. I mean, no muscle, no bone, just fat. What can you lift, right? 200 pounds of just pure fat can lift no weight, right? In other words, there will be no output. In other words, you want it to be lean and mean. You want it to be just, lean and mean, pure muscle and bones, and then the efficiency or the productivity of that 200-pound structure would be, very high. And as an investor, you want to invest in such 200 pounds rather than 200 pounds of fat that has no zero productivity, right? So if you measure that in our example, our total assets was 10 billion, right? So it's 1 billion over 10 billion, right? I know it's going to be 10%. Now, we can also notice one thing. Mathematically, between ROA and ROE, which one is mathematically bound to be greater? Of course, ROE is bound to be greater. Why? Because of the different denominator. right? Basically, the numerator is the same. And then if the numerator is the same, whichever one has a smaller denominator will end up in a greater fraction. Make sense? And since equity, if you're looking at the same company and measure its ROA and ROE, return on asset, return on equity, because equity is one part of total assets, right? The other one is debt. This ratio will always come out greater. Make sense? But then think about it. Return on equity is the most relevant number for the equity holders or stockholders, right? Or shareholders, right? But since profit doesn't go to the bondholders, this number is actually not useful for bondholders. For bond or debt holders or bondholders or creditors, right? For creditors, ROA is more relevant number, right? But then again, you might say it's unfair. I mean, because this is more relevant to the debt holders because total assets include debt, right? Total assets is debt plus equity, and it is still a not a very fair measure. Why? But anyway, profit is still it doesn't relate to, it's not relevant to the debt holders because this belongs to only the equity holders. So actually there is a variant of ROA, for debt holders, right? Because from the debt holders' perspective, using net profit is not a fair measure. So they used, so for the creditors or bondholders or debt holders, EBIT, the operating profit, is a better measure of profit, the operating profit. Why? Because in EBIT, the interest payment to the debt holders are included. So sometimes ROA is measured this way. If you measure it this way, then there is no guarantee that this will always be greater than OE. Okay, makes sense? All righty. So that's it for this segment of the video. I'll see you guys in the next video. Okay. Thank you for watching, and stop recording.